Hey guys, welcome to DevTech Finance, and in this video we would be covering the topic credit policy. It is a part of credit management module in which I have uploaded many other videos. So let's start with this topic. Credit policy defines the course of action or guiding principles that influences decisions of lending. So, because banks and financial institution deals with money, they are providing loans, they are accepting deposits, there are certain rules and regulations set to make sure to ensure the safety and security of the money depositors, as well as to make sure that the money which has been provided as loan comes back in the form of interest and there is no default made by the borrower. So there should be a certain set of policies which should guide the action of the various commercial banks so that this risk of defaults and the safety could be ensured at the maximum level. So credit policy is the generally set of rules and regulations which is formed to minimize the risk because as I said, banks and FIs deals with money, deals with lending and borrowing, deals with lending and borrowing of money, accepting deposits and all. So risk involved is quite high, and that also in a huge amount, a huge quantity. So the risk to minimize that, rules and regulations are set through credit policies. Loans constitute the most important assets of bank. Therefore, the policies which govern the dispensation of loans should aim to promote both quality of loans and earnings from portfolio. So here we are talking about credit policy, which is defining the guidelines when you are lending, when you are providing loan. So the courses of action that needs to be taken, the rules and regulations that need to be followed before lending to any borrower, which could be an individual or an institution. So the quality of loans to make sure that the loan does not get into substandard, default or loss asset, and it becomes a standard and quality assets for the bank from which the earnings could be improved. So to ensure all these things, credit policy comes into picture. Then we'll talk about the objectives of a sound credit policy. So the first one is credit volume. One of the objectives of the credit policy should be to promote the desired level of growth in the volume of loans and advances. So now every bank is a competitive entity in today's market, and as such, growth becomes very important. They try their best to they try their best to improve the market share and retain most of the customers. Hence this is also one of the policy to have a large credit volume, to have a large market share by acquiring more and more customers towards your bank. Then the second one is earning. The credit policy framework should ensure that the rate of growth in loan portfolio is matched by an increase in interest and other earnings from the loan asset of the bank. So credit policy make it sure that the earnings does not get into default, and there is increase in the interest earning which is payable by the borrowers on the loan they have taken. So growth in any business is meaningless unless it is accompanied with the earnings. So profit plays a major part because that is how the bank's operation would run upon. If there would be no earnings, it would get into the collapse stage. So earnings should be focused on, and it should be tried to increase. The default should be tried to lower down, and all those management of reserves to avoid these defaults should be done so that the earning is not compromised and the operations and the business operation of banking is not compromised. Then the asset quality. Credit policy should aim to create and maintain quality assets. Without quality, the earnings will be compromised. So here by asset quality, we mean that when we are providing loan, we need to make sure that we are providing loan to clients or customers who are trustworthy and would be whose repayment capability is good enough, who would be able to repay the EMIs and who would be able to repay the EMIs and not make any default intentionally or through any means, intentionally or even through or even financially. So It is responsibility of banks and FIs to do a proper credit investigation before providing loans to make sure that the asset quality which we received in form which we are going to receive in form of interest is going to be good, and it won't convert into bad loans, because bad loans not only stop earning interest, but it also requires provisions which lower down the profit. So once the loan has been defaulted, it is considered as bad loans, because the chances of getting it recovered is very less now. And for this reason, there is also a provision or reserve made, which is cut down from the profit every year, and kept as a reserve, so that the business operation of bank is not compromised because of this bad loans. So it is also lowering down the profit, it is eating out into the profit percentage of banks. So it becomes very important to follow the credit policy and make sure that the loans being provided are of standard quality. Then there is regulatory prescriptions. Credit policy should ensure rules and regulations set by RBI and government to be followed by the commercial banks. So, for example, RBI has said that commercial banks need to maintain this cash reserve ratio and SLR, so that the liquidity in the bank is maintained. Some portion of their net demand and time liabilities should be maintained with RBI, and which would serve as a liquidity position, which would help ensure the working capital management with the banks. So this is how there are some rules and regulations set by RBI, which is mandated and needs to be followed by all the commercial banks. So, for example, there is also this capital adequacy ratio which need to be maintained. And then there is priority sector lending. So this involves creation of policies that help in the flow of credit to priority sectors mandated by government for development of economy and society as a whole. So government has decided that 40% of the loans should be provided to these sectors which are termed as priority by government, because these sectors play an important role in overall development of economy and society. So it may be neglected by bank because the earning is not much high. Therefore, government has mandated it that 40% of NDTL should be provided to these priority sectors, and these include infrastructure, education, renewable energy, and agriculture. So these are some of the examples of priority sectors. Coming to the credit policy contents, so till now we have seen that credit policy covers the lending terms and conditions. So what all rules and regulations need to be followed before providing loan to any borrower. What is the regulatory prescription? So the reserve ratios which need to be maintained, the cash reserve ratio, the statutory liquidity ratio, it's all to ensure that the business operation of banking is not compromised with. So there are various regulatory prescriptions mentioned as well, related to lending as well. So when we are providing loan, we need to do the credit checking, credit investigation, and the credit rating check, the CIBIL score, all these things to make sure that the loan does not become default. Then asset quality, to make sure that the loan which we are providing, we would be able to earn interest on it, and the asset quality is of standard, and we are not providing loans to those borrowers who would not be able to pay. So for this purpose, we are doing a proper credit checking of the borrower. Then advances to sensitive sector. So credit policy also mentions some of the sensitive sectors which are related to share market and brokerages firms. So there are special guidelines when we are going to provide loans to these sectors, because the the market risk involved is really high. So there needs to be a separate set of policies and procedures when we are providing loan to these sensitive sectors. Then priority sector lending, as we discussed about. Delegation of power. So proper delegation of power is done in banking scenario where the authorized signatory are appointed who would be approving the loan after making sure that each document is submitted carefully and proper credit process has been followed relating to credit investigation, proposal, disbursement, everything. The lending methods is also prescribed in credit policy, the credit risk rating framework. So any credit rating above 750 and in between 750 to 950 is usually considered good by many of the banks and financial institutions for lending. And this credit rating in terms of businesses also and individuals also in terms of credit score should be checked to get an idea about the credit behavior, the past credit behavior and credit history of the customer. And pricing strategy. So pricing strategy is also set in the credit policy. What should be the interest rate to be charged, and what would be the base rate, etc. So all these things are mentioned in credit policy. Okay, so thank you for watching. This was all about credit policy. Do like and share my videos. Subscribe to my channel DevTech Finance. Thank you.